Hey Lisa,
Good morning. I've never been able to come to this before.
awesome. Well, I'm glad you were able to make it this morning.
Well, I watch my grandkids on Tuesdays and Thursdays
Hmm.
during the school year, and school's out.
Yeah, summer break. Well, thanks for hopping on, and hopefully you get some good little tidbits in here. But yeah, we'll probably give it another minute or so before we get started.
Yeah, no worries.
Hey Lee,
How you doing, Chris?
good. How are you?
Doing good. Just
Good.
dealing with the kids off of school, as she was saying earlier.
Yep, I know that feeling.
I know you know the pain. I mean, the enjoyment.
Yeah, yeah, exactly. It's a love relationship.
Yes, sir.
It goes really, really fast. Just saying.
Oh, it's
Yes.
going. It is quick.
The years, the days are long. They're so long, but the years go by so quick.
Yes,
Yep.
they do.
My oldest one's just starting middle school next session, so it's crazy.
Yeah, my youngest just graduated from high school.
It's wild.
But I've got grandkids, and my 5-year-old grandson starts kindergarten in the fall.
That's crazy. That's awesome,
Yeah,
though.
it is awesome.
All right, I'm gonna get off. Let you guys do your thing.
Perfect. Yeah, we'll go ahead and get started here. I thank you. I see all the other joiners out there, Ryan, Lynette, Kelly, and Kochi. Thank you for hopping on here. We'll go ahead and get started. Yeah, as we normally do, we get started with our good old article from Mr. Logan. I think it's Matashima or something. I think I butcher his name every time I try to say it. Motashami. See, I was close. All right, so we're gonna go ahead and get started here with this just this national market update. So this article here, we're gonna dive into housing inventory first. So essentially, what he saw with housing inventory is it did turn negative year over year last week. So we did see a decline there. The weekly inventory, however, though, oh, let me fix that. Uh, there we go. Sorry, technical difficulties. Anyways, the weekly inventory did increase slightly. So 2026, we went from 794 286 to 795 921. However, the Memorial Day, it did impact the data, so we should expect some rebound noise nationally in next week's report. Um, but ultimately, I think a couple of things to keep in mind as we go through this. The inventory growth last year reached nearly 33% year over year, which helped largely by higher mortgage rates slowing the demand. This year obviously has been slightly different. So what we're seeing this year, obviously mortgage rates have mostly stayed under 6.64. That is the lowest rate environment since 2022. And even with the rates climbing from 5.99 to 6.75, what we have seen is that buyers are still continually showing up. So that stronger demand has naturally made the inventory growth harder to maintain. Um, but again, some things to think in mind there. Obviously, Memorial Day temporarily kind of distorted the data here. The slower inventory growth does reflect stronger demand conditions. And then even with the negative year over year reading, overall, the inventory positioning does remain healthier than it has been over the years past. So again, something just with this inventory, don't let negative year over year headlines, create that fear that people will see. The inventory levels today are still far healthier than any recent years. And obviously, as we dive into this stuff, the context and the local interpretation that we can have will matter more than just what the single headline says. So as we dive into new listings, what he saw with new listings this week, they did drop sharply, falling from 2026 is 71,249, but it is still a year over year increase from 70,414. The decline we did see, because I believe we were in the 80,000 range last week, the decline we did see again probably followed or happened because of the Memorial Day weekend, which just historically causes that annual dip in listing activity. So the big picture, obviously, we want to still see this. Back up to 80,000. Still looking for our first back-to-back weeks above 80,000. As he mentions many times, 80,000 is kind of the range we look for around this time of the year. So we want to get back there, but we'll see where it goes next week. Again, with the holiday weekend. That changes a little bit of things. So ultimately, again, watch the trends here. Don't let just one week affect it as we've seen here. One week changes very quickly. Obviously, in the last few weeks, we've been up and down and up and down and up and down. So we'll see where this looks like next week. Now, as we get to price cut percentage, what we're seeing in the price cuts. Now, keep in mind, typically 1/3 of all homes do undergo a price reduction before selling. That's just a national average, and it's normal market behavior. So, with this, what he did see is our price cuts remained very stable. We're at 36.88% as opposed to last year, 38%. So we are still below last year. Which, as we've seen, is kind of where we've lived lately, is just slightly below last year, almost the entire time. So, I definitely would say, as far as big picture with the price reductions, um, earlier this year, mortgage rates did fall more than we expected, and the housing demand still held up surprisingly well. And obviously, that matters because if the rates do move lower and the inventory remains negative year over year, it's going to become harder to make the case for significant national price declines. Um, Now, what it ultimately means or what we can take away from the price cut piece of it, obviously these, forward thinking and whatnot, but price cuts are normal. Again, 33% of the homes are going through this, just national average. So it's not a panic signal, and we are right around that 36 or 33%. Sellers do still need a strong pricing strategy and market position. So again, I just can't stress it enough. Having the conversations about pricing beforehand, or at least having a plan in place of any pricing reduction strategies, that's going to be huge. So just keep that in mind. Now we're going to skip over the 10-year mortgage just because I always say stay in your own lane, and mortgage is not my lane. So now we're going to dive into weekly pending sales. So what we're seeing with weekly pending sales, um, the pending sales did soften last week, but we're still remained higher than last year. So we are at 69,215, which is higher than the 68,071 from the previous year. Again, Memorial Day weekend significantly impacted this data line, which had been trending upwards until this last week. So before we overreact at the weekly pending sales, um, just keep in mind pending sales is obviously very sensitive to holidays, timing shifts, short-term market interruptions, things like that. And obviously Memorial Day is one of those things that will typically create a noticeable slowdown. With that being said, obviously too, rates do still matter. So the mortgage rates above the 6.64 trend typically tend to soften the housing activity. Um, what with when we look at this pending sales, what we can kind of take away from it is, again, same thing as the other ones. Watch the trend, not just one holiday week. So we'll see where it comes back to next week if it shoots back up. And then the rates do deserve close attention, but obviously what we're seeing is the demand still hasn't fallen apart. So again, and the last thing to keep in mind with these is it is a forward-thinking indicator as well. Pending sales today become closings typically in the next 30 to 60 days. So it is a good way to, important market tracking data piece. So, all right. And then the last piece of this article here is going to be mortgage purchase application data. So what he does typically like to see is at least 12 to 14 weeks of positive week-to-week data. So the purchase applications were essentially flat week to week. Notice there's really not a big change there, but we are still up 5% year over year. So the buyer demand cooled slightly, but it continues to hold positive compared to last year. Again, this matters. It is a forward-thinking indicator, typically leads to home sales by 30 to 90 days. So it gives us kind of an early read on where housing demand may be heading next. Um, as he mentioned earlier, we're looking for the 12 to 14 weeks of positive week-to-week data. And so far this year, what we've kind of seen is all over the place. We've had 9 positive weekly prints. We've had 9 negative, 2 flat weeks, 18 positive year over year weeks, and 9 weeks with double digit year over year growth. And there's only been 2 negative year over year. So this does tell us something important, which is obviously the weekly momentum has been mixed, but overall the buyer demand has stayed positive for most of the year. Um, Now, as we watch this, or we continue to watch it, now that mortgage rates are getting slightly above the 6.64, it does kind of become a critical data point, just because what he mentions in here is historically, housing data does demand, or the housing demand does soften once we get above that 6.64 threshold. And then the pressure grows if the rates move above 7%. And that's just typically what, nationally what he sees. So ultimately, purchase apps help us kind of understand tomorrow's market, not necessarily today's or yesterday's. But the flat weekly movement with positive year-over-year growth is still supporting that we have a resilient housing market out there. And the rate movement remains that the variable, or I'm sorry, the movement is still the variable that deserves the closest attention. So we'll just kind of keep an eye out on that rates too to see how it affects this mortgage purchase application data. So, all right, diving into our next one here. So this is called, obviously, because I just want to keep everyone updated on the Compass, Zillow, MLS, all that fun stuff, the MLS wars, as they call it. So this is Lamechia, I will sue Compass MLS if listing fight comes to town. So ultimately, what he's talking about in this article, and it's a very short one where he's basically just interviewed. Um, but this is a brokerage owner, Anthony Lamechia, who says that if Zillow and Compass, if that listing battle does continue to spread into MLS markets and results do feed, gosh, what am I doing to my computer? Sorry. And so if the results do feed into cutting off both pieces or any pieces for that matter. He does say that he's going to go sue Compass and the MLS involved. So his comments obviously are coming as there's a hot debate, a hot topic in the world we live in with over private listings, MLS control, portal power, and who controls that listing visibility. Now, ultimately, what he argues is that it's pretty straightforward that maximum exposure matters. So he thinks that the sellers deserve broad exposure. He thinks that the buyers do deserve equal access and that listings should not be restricted to benefit one brokerage or company. Obviously, the concern of a listing war is that large brokerages begin keeping listings internal, then other brokerages may retaliate, and smaller firms could struggle, and the industry fragmentation could accelerate. And obviously, when you're holding listings, then are you really getting the best exposure for your sellers? So he stands on a pretty firm step that we all kind of see out there, whether or not we're on the same side of it. Now, the one thing I'll mention about this, as far as KW, is we thankfully are already in the process. KWRI is in the process of making sure we have a backup plan should this come to our neighborhoods. So we have a partnership with Cotality, and they're working on the BLX. And essentially, what we could see down the road is if this does happen, we'll be ready for it because basically we'll have it to where whenever you do have a listing, you'll be able to decide with your seller where you want that listing to syndicate. So you'll be able to basically input the listing straight through command. And then once you're inputting the listing, kind of the same way we do it through MLS, you would then select little toggle buttons of where you want these listings to syndicate. So if you want it on Zillow, you hit the Zillow toggle. If you want it on, Redfin, you hit that, and you'll basically just have a list to go down if you want it on the local MLS. And so all the control and power will still lie in our hands, our sellers' hands, versus relying on some of these MLSs and things that, who knows where it's going to go. So that is one thing I want to just mention there. As far as this article, what, as a KW agent, what we can take away from this is it's just another reminder that the listing strategy matters more than ever. So we need to understand the MLS rules, the syndication, the portal relationships, private listing conversations, and also, the trade-offs for, good exposure or maximum exposure versus limited exposure. Because consumers are obviously going to be asking, and they are asking, where's my home showing and why? And so we need to make sure that we have those informed answers. So ultimately, with this article, I think the biggest thing is the listing debate is no longer just about marketing strategy. It's becoming a fight over who controls access to the marketplace itself. But regardless, we already have plans in place to make sure that we're safe. But I just always like to keep you informed on this one here. So. All right, now we are going to dive into this one. So this is another big kind of merger acquisition because it seems like that happens here pretty consistently now in our real estate world. This is Berkshire Hathaway buys Taylor Morrison an $8.5 million all cash deal. So essentially, what this one's talking about is Berkshire Hathaway did announce plans to acquire Taylor Madison, which is a builder, in an $8.5 billion cash deal. Berkshire will pay $72.50 a share, about 24% premium over the Taylor Morrison's recent stock price. And Taylor Morrison will now become a private company with Berkshire's portfolio once the deal closes. So, kind of a little background, who is Taylor Morrison? Taylor Morrison is a national builder. They have over 350 communities, they're in 21 different markets spread across 12 different states. And they're basically serving, entry-level buyers, move-up buyers, and the resort lifestyle communities. They also do operate in the mortgage services world, the title and escrow, the homeowners insurance, rental housing under the Yardley brand. But why this matters is it's more than just a home builder acquisition. It does signal something bigger, that Berkshire Hathaway is making another major long-term bet on the U.S. housing. So they already do own Clayton Homes, building product companies, and housing-related businesses. But now it is expanding deeper into the site build residential housing. So Berkshire's CEO Greg Abel in this article did say that his goal is to eventually create a more unified home building platform. Um, so ultimately, what it means is the large institutional players do not make multi-billion-dollar housing investments expecting the industry to disappear. So they're still in it for the long run. This deal, I would say, suggests that the confidence in long-term housing demand, its continued belief in the U.S. population and the housing needs, and it's an ongoing consolidation inside the building industry. And that's happening even while we have these higher rates and all these affordability challenges, and even with the market volatility that we're seeing, the big capitals continue to moving into housing, which I think matters. Um, so again, kind of what we can take away from this one is it's an important perspective, but housing remains a long-term asset class that major institutional investors continue to bet on. So while headlines often focus on short-term volatility, the builders are expanding, the capital is investing, and housing demand that continues to drive strategic decisions. So for us, what does that mean? Well, it means that new construction does still remain an important conversation. It's still out there. And builder relationships do matter. Obviously, we're always getting those constant texts of, spam texts and whatnot, but building a relationship with a builder could definitely have its benefits for you down the road. So understanding the local builder activity will create opportunity for you. Boom. All right. We are another article by Logan here. So this one is credit card and auto loan delinquencies do look like 2008. Housing does not. So what Logan talks about in this article is what's happening is that serious delinquencies on credit cards and auto loans are rising to levels that we've not seen since the great financial crisis. The saving rates have also fallen, reaching a 2026 low of 2.6%. So naturally, this has reignited fears that housing could be headed toward another 2008 style crash, just like we see in all those fear-mongering headlines that we see pretty weekly. But if you look at the actual housing data, it's going to tell a different story. So the key distinction is renters versus homeowners. One of the most overlooked part of this conversation is that credit stress does tend to show up far more among renters than homeowners, which has historically been true and it still remains true today. So while credit card delinquencies, auto loan stress, customer debt pressure, all those things are rising, homeowner financial profiles continue looking remarkably strong. So why does the housing look different? Well, two major regulation changes reshaped this mortgage lending. Number one was the 2005 Bankruptcy Reform Act, and number two was the 2010 Qualified Mortgage Rule, the QM rule. These changes dramatically tightened the lending standards and made sure borrowers had stronger ability to repay qualifications. And the result of that is that today's homeowners generally have a stronger FICO score or better debt management, healthier credit utilization, and a more stable cash flow. So on paper, homeowners have arguably never looked stronger than they have over the last 15 years. Student loan stress, he does mention in here, but that's not a housing trigger either. Student debt is often mentioned as another warning sign, but this is nothing new. We have dealt with elevated student loan stress since roughly 2010, and it has not created housing inventory spikes. It has not triggered foreclosure waves, and much of the delinquency data comes from smaller loan balances tied to non-completers. So what does this actually mean? The article does reinforce an important distinction that consumer credit stress does not equal housing collapse. Yes, credit card stress is real, auto delinquencies deserve attention, and household budgets do face pressure, but it does not automatically translate to housing distress or, forced selling or essentially the 2008 style foreclosures that we've seen in the past. The housing market simply operates on a different credit foundation today. So again, what we can kind of take away from this article is that this is an education opportunity. Your clients might hear credit stress is rising, we must be heading for another crash. But us as market expert agents can help explain to them that the housing and the consumer credit are not the same thing, that today's lending environment is fundamentally different, and that the rising delinquencies deserve awareness, not panic. So overall, one liner from this article here would be that credit stress may be rising, but today's homeowners are operating from a far stronger financial foundation than they were in 2008. All right, so now we're gonna hop on this one. Inman, 7 things top agents are doing right that nobody talks about. Oh, actually, sorry. We're actually going to go to this one here. I mixed that up. So Wells Fargo to offer mortgage incentives on 3D printed homes. This is something interesting that was mentioned by Bob in Coffee Talk. So I thought I'd see if I could find any, or no, I'm sorry, by Mitch in Coffee Talk. So I want to see if I could find anything on it. But ultimately, what's happening is Wells Fargo is partnering with Icon, which is one of the biggest names in the 3D home construction. So you'll see all those 3D printers out there where they're printing all these cool little toys and gadgets and whatever it might be. Well, now they're printing houses using 3D printers. So the lender, Wells Fargo, will now finance mortgages for qualifying 3D printed homes. It does offer buyers a 50 basis point lender credit, and it provides financing options for builders purchasing Icon's 3D printed technology. Now, this is pretty important as far as for years, I guess they've been doing it for years, which I was not aware of. But for years, the 3D printed housing has always faced one major obstacle, which is financing, because naturally lenders do have concerns lending on a home that is 3D printed. They're worried about the long-term value, the resale potential. Insurance is always a big one, and whether the technology was truly market ready. So that hesitancy kind of limited growth, but now a major lender, Wells Fargo, is stepping in and saying that we believe this product is ready, which is a significant shift. Now, if we back up a little bit, who is Icon? Well, Icon has become a leader in the 3D printed housing technology, its faster construction methods, and its lower cost building systems. So their homes are already being built through projects including Lennar, who has communities in Texas, the workforce and attainable housing developments, and the philanthropic housing initiatives. Now, their newer Titan printers, which is the new version of their 3D printers for homes, those can even produce larger homes or multi-story structures. And it's also faster construction timelines because there's no labor. They're just putting a printer there and printing it. So ultimately, why this is interesting for housing, I think the first large-scale 3D printed communities have already shown that there's strong buyer interest, fast absorption, they usually sell out pretty quickly, and a competitive resale confidence. So people are reselling these homes now, and it's showing as well. So this is moving, I would say, 3D printed homes is moving from experimental to definitely more of a mainstream conversation. And as we've seen that, in the real estate world, it's another creative option out there essentially because we're seeing ADUs, creative density models, modular and alternative construction. We're seeing AI assisted development, and now we're seeing these 3D printed homes. So ultimately, I mean, this is not a transformation for every neighborhood. It's not going to happen, in neighborhoods around us tomorrow, but it does matter. And I think we should be paying attention to this because alternative construction is gaining credibility. And obviously, there's buyers that we have that are always looking for some sort of creative way to get them into their home. The financing barriers are shrinking now that Wells Fargo will lend on this, and probably soon others will follow. And the builders are experimenting with new models, and the buyers are now becoming more open to non-traditional housing options. So ultimately, I would say, when the major lenders begin financing and incentivizing new housing technology, it is a signal that innovation is moving from the sidelines into the mainstream housing conversation. So definitely just something we got to keep in mind there. Now, I did want to dive over into the local stats because obviously we heard the national stats at the beginning. So now let's look at the local stats real quick. So last week, new listings, we were at 1,328. Well, we're at 1,633 today. So that's increased. Last week's coming soon was at 234, and we're seeing that at 270 now. So another increase there, and I'm just going to spoil it. These are all increased from last week. So back on the market, we saw 247 last week. We're seeing 314 this week. Price decrease. This one was pretty significant. We were at 1,627 last week, and now we're at 2,367. So around 600 home increase there. And then pending was 1,212 last week, and now we're at 1,448. And the close that from last week was at 1,036, and we actually closed another additional almost 600 more at 1,633. So we're seeing some movement still in our local market as well. Now, ultimately, as far as a big finish for this week and kind of a quick run through of what we just went through, I would say if there's one theme that connected everything that we covered, it would be that housing keeps adapting. And it seems to be that way every week. Even when the headlines expect it to break, even when we see the doom and gloom headlines where everything's falling apart. Um, and let's think about what we talked about. The inventory officially turning negative year over year. The demand is continuing to hold despite higher mortgage rates. The new listings working their way back towards the healthier levels. The price cuts are staying remarkably stable. The major capital flowing into housing through Berkshire Hathaway. The consumer credit stress is rising, but housing fundamentals are still staying strong. The ongoing listing wars are reshaping how inventory is controlled and distributed. And now we're even seeing lenders who are supporting 3D printed homes as a legitimate housing option. Now, that's a lot of change, and yet we're still seeing the market move. So I think this week has reinforced something important. Housing, again, is not frozen, it is evolving. The market is constantly adjusting to rates, technology, consumer behavior, construction innovation, and even industry competition. So the agents who win are not the ones, waiting for the conditions to become easy. They're the ones who are learning how to operate inside the conditions that we have. Um, so how can we win in this market? It's not through fear, it's not through those doom and gloom headlines, but it is through our market knowledge and it's through consistency, consistently educating ourselves and consistently educating our clients. Technology adoption, the strategic conversations of, if you're listening, to have that strategic pricing conversation about what's going to happen if we notice we're sitting on and we're not getting any bites. So consumers don't need to panic. They just need leadership. And us, that's us. So the informed agent is going to become the trusted advisor. So ultimately, this market is not rewarding the loudest agents. It's rewarding the most informed, the most adaptable, and the most consistent professionals willing to lead through that change. So that's all I've got for you guys this week. I appreciate all of you hopping on again, as usual, and hopefully you all enjoy your Tuesday and have a wonderful week.
Thank you, Chris.
Thank you.
Thanks, Chris. You guys.
Thanks, Chris.
Bye.
Thank you.